Welcome, dear traders. You are watching a recap of the Asian trade on April 7 with me, Kate Tichina. Yesterday, Wall Street completed a short trading week on an optimistic note. In turn, Asian markets traded mainly higher today. No wonder Asian markets traded sluggishly today in anticipation of the event of a crucial importance. Most stock markets are taking a break until next week, so the currency market will give the strongest response to the US non-farm payrolls. Meanwhile, there is plenty of evidence that the economies in the United States and Europe have lost momentum. The International Monetary Fund downgraded its forecast for the global economic growth to 3% for 5 years ahead. It's the weakest forecast in the last 30 years. Nowadays, especially in light of the recent bank crashes in the United States and Europe, cooling down in the US labor market could escalate fears about a recession in the top global economy. In response, investors will rush to sell risky assets, which could entail panic sell-offs in the global stock markets. On the other hand, upbeat non-farm payrolls will support the Federal Reserve in its hawkish agenda. Previously, several Fed policymakers stated that the regulator was ready for more rate hikes and thus expressing their commitment to bringing inflation down. St. Louis Fed President James Bullard said yesterday that financial stress seems to be abated at least for now, and so it's a good moment to continue to fight inflation and try to get on the disinflationary path. All in all, both the downbeat and upbeat non-farm payrolls pose a threat to the stock market. Under such fundamentals, market participants should make well-rounded and prudent decisions. Perhaps the fact that the exchange floors are closed on a Good Friday will cushion investors from hasty moves. The US dollar will take the punch from the non-farm payrolls later today. The greenback traded quietly in the Asian session. Having dropped to the lowest level in 2 months earlier this week, its index rebounded to 101.90 in the Asian trade. The US dollar index traded in a narrow corridor between 101.90 and 102 on early Friday against six rival currencies. Besides, yields of the benchmark 10-year Treasuries slipped to the lowest level in 7 months. As a rule, bond markets are less prone to emotions. Hence, they commonly give muted responses to macroeconomic data. So record fall in the US Treasury yields is bearish for the US dollar by default. Commonly, falling yields of the US Treasuries bolster confidence in the Japanese yen. However, the yen is following the opposite trajectory today and not benefiting its status of a safe haven asset. It's losing ground against the US dollar. The underlying reason behind the yen's weakness is domestic factors. First, the Bank of Japan made record-high investments in government bonds in late March. In one of the previous videos, we said that yields of Japanese government bonds topped the landmark level of 0.5%, and for this reason, the central bank purchased bonds worth a whopping 136 trillion yen. This amount is twice higher than the investment of the last year. Japan's leading index climbed to 97.7 points, the highest level since October last year, and this index measuring future economic activity confirmed the steady recovery of the national economy. So the yen also weakened following yesterday's speech by Japan's Prime Minister Fumio Kishida. He said that the ongoing monetary policy would unlikely to be revised, and the Premier and the new Bank of Japan's Governor Katsuo Ueda are due to meet on April 10. The Prime Minister expects the new governor to confirm the intention to maintain the ongoing ultra-loose monetary policy for a while. In this context, the dollar-yen pair is extending its moderate growth. Resistance and support levels are recognized at 132 and 131.50. The currency pair tested 131.90 twice during the Asian trade, and the next resistance is seen at about 132.5, and the next support is at 131.5. The antipodian currencies came under pressure today, but Jean called on Australia to create a beneficial environment to develop trade and economic cooperation between Australia and China. Beijing appealed this way after Australia banned TikTok from all federal government-owned devices. Judging by the Australian dollar's advance, it has been still immune to tensions with a well-established trade partner. The Aussie traded higher in the Asian session within the corridor between 0.6667 and 0.6693. The Australian dollar is growing during the consolidation of the greenback ahead of the US nonfarm payrolls, and the AUD USD pair traded at 0.6679 in the early Asian session. And you have watched a recap of the Asian trade. InstaForex TV channel keeps you updated on the red hot news and analytics. InstaForex team wishes you a happy Easter. Enjoy a long Easter weekend and see you online very soon.